Hello everyone. Today I want to chat about what has been the market driver for the last few years. Artificial intelligence. Artificial intelligence, also known as AI, is powerful and transformational. But markets may already be pricing a lot of success. So what is going on with AI? Are we in a bubble? And what does that mean for investors? Number one, it has created huge winners. AI has driven markets because investors believe it could transform the economy. The first winner were the companies that already owned the building blocks: cloud infrastructure, data center, AI model, distribution network. That is why, in the early phase of the AI rally, the large technology platform benefited the most. Those are called the hyperscalers. From the end of 2022 to mid-2025, their performance was very strong. However, today, the AI story may be moving from the platform to the suppliers. During the gold rush of the 19th century, many miners struggled, but the sellers of picks and shovels often prospered. In today's AI cycle, many investors point to the semiconductor company as the modern picks and shovels, as they believe they provide the essential tool to make AI possible. What we can see is from the end of 2025 to this July, the hyperscaler had a decent return, while the semiconductors saw particularly strong performance. But there are signs of excesses. Today's investors are watching four areas closely. Market concentration. It is unusually high, similar to levels seen in bubble of the past. Some AI-related shares have experienced extreme price moves, sign of exuberance. Pricing power may be starting to weaken, and AI adoption remains lower than headline stories suggest. Again, none of these prove a bubble exists, but together they suggest that expectation may have become a bit ambitious. This signal deserves as much attention as the more positive part of the story, particularly the level of concentration and the reliance on continuing spending discussed next. The biggest question is not whether AI is useful. The biggest question is whether current spending will generate enough future profits. Some of the largest AI companies are investing in each other, buying service from each other, and funding each other's growth. This creates a powerful investment cycle. One company spends heavily, supplier receive revenue, supplier reinvest, the cycle continues. As long as demand keeps growing, this works well. The risk is that if one major participant slows spending, the effects could ripple through the entire ecosystem. The concern is not that AI is fake. The concern is that spending growth may currently be feeding on itself. If future demand is as strong as expected, this investment will be justified. If not, today's spending could look excessive in hindsight. Well, does that mean we should avoid the sector altogether? No. Market may be optimistic, but optimism is not the same as speculation. Many AI-related businesses are showing rising revenue, improving margin, strong demand. Genuine productivity benefit. The technology is not simply a concept. It's already producing measurable economic value. The debate is not whether AI matters. The debate is how much future success has already been priced into share price. That is the question. Does the pick and shovel theory still stand? First, history shows that the biggest winners are not always the company with the most publicity. Often, the winners are the firms supplying the tools. today's semiconductor company, memory supplier, or infrastructure businesses, those firms are generating stronger profitability than the better-known AI platforms. Second, in the past, most speculative bubbles have collapsed after rate hikes started. It was true during the Japanese bubble. It was true in the dot-com bubble. And that was true in the 2008 bubble. My own reading of the current environment is that the new rate hike cycle looks unlikely in the near term. But of course, that could change. It's not a guarantee. But again, we need to be cognizant of the facts. So, how should you approach AI? Well, first and foremost, remember, there is more than one way to get exposure to a theme. And the most obvious might not be the best. Number two, never follow the hype. It's often when it is too late. Number three, great story don't make good investment. And a great company is not automatically a great stock. Number four, past performance is not a guarantee of future performance. It's not because something has performed well that it will do so in the future. Number five, investing is not betting. You cannot control the outcome, but you can control the process. Always follow a disciplined approach. And finally, please, your advisor is here to help. If you have any short-term concern, please do speak to them. They will help you. So, our conclusion is not that investors should avoid AI, nor it is that investors should put all their money into the latest AI winners. The sensible approach is to gain exposure while remaining diversified and disciplined. As I have talked about investment, I must remind you that capital invested is at risk, and future performance cannot be guaranteed. If you have any questions or comments, please contact your financial advisor. Thank you for your attention.